I want to talk a little bit about three major topics that seem to be important in the markets right now. The election, and I'm going to address that from the horse race standpoint. Before we get into the ugliness of politics and religion and what you believe or don't believe, we got to figure out who's going to win first, and then we can kind of go from there. And that's what I wanted to address first as far as where we are with the election. And the takeaway there is, as of this moment, it would be a photo finish. And it would be a photo finish with Colorado being the new Florida, where we'd be up until 3 o'clock in the morning waiting for some Colorado returns to decide who's going to be the presidency. But that's today, and we'll have to see where that goes from there. Then I want to talk about this fairly new phenomenon of negative interest rates. It's more in my wheelhouse a little bit. I'll show you a little bit in the beginning here that I actually have a chart of interest rates going back 5,000 years. And what you won't see on that chart is negative interest rates. That did not occur until 2 years ago or 3 years ago. And that is a brand new phenomenon that everybody's still struggling to understand and figuring out what it means. And then I want to finish up by talking about how this negative interest rate environment, this post-crisis environment, this post-2008 crisis environment has been very, very difficult for traditional money managers in that they've been really struggling with this environment. So with that, let me start with the election. This is the Real Clear Politics average of the polls. So the blue line is Hillary Clinton, the percentage that she's been getting in the last 6 polls on a rolling basis. The red line is Donald Trump, and the bars in the bottom are the difference between the two. All these charts I'm going to show you were as of Monday because I wanted to stop them right at the first debate. Historically, between the conventions and election day, the most important thing that happens, unless there's a surprise somewhere, is the first debate. That seems to have tendencies to really change things, or in some cases not change things, but that's your kind of where you would look for the event. As of Monday, according to the Real Clear Politics poll, Hillary was up by 2.3% over Donald Trump. If we take a look at this table right here, 2.3%, the last time we saw the race this tight going into the first debate was 1980, when there was a 2.1% lead by Ronald Reagan over Jimmy Carter. So it's been a long time since we've had a race that has been this close. Coming out of the first debate, what this table shows you here is where the race was before. The race was after the first debate. The average move is about 3.7%, around a 4% move for who's ever perceived to have won the debate. And this little chart right here just shows you we plotted the gains and before and after the debate to come up with that 3.7% gain. Now, of course, this assumes something that is very difficult to assume in this environment, that the history holds now. Everything is so unconventional now, it almost seems like there's 3 questions you have to ask. Who won the debate? Does it matter? And how long will it matter? Will it matter till the second debate, or will it matter all the way through? In a lot of historical elections, it matters all the way through. So we'll have to see, where are we right now? This is the 538 blog, Nate Silver's blog. If you're not familiar with him, he's from Chicago, graduated from the University of Chicago. He is a statistician that looks at a lot of the polls and puts together a lot of models. He ran the New York Times' website in 2012, where he had a 100% correct prediction rate on the election. What I want to say, the reason I'm showing this is a model to predict where we are. This is, in all investing, I like to think the proper way to do investing is, where are we in the world? What do people think? What do I think? How much is my view different from the consensus view? And if it is, there's an investment opportunity. If it isn't, if I'm right on the consensus view, then there isn't much of an opportunity. So where are we as of Monday, according to the 538 blog? 55% chance of Hillary winning, 45% chance of Trump winning. If you look very closely, they're projecting 277 electoral votes for Clinton. They're projecting 261 electoral votes for Trump. This is as of Monday, right before the debates began. And you can see that the race has really tightened up. Really what it comes down to is Colorado. They've got a 57% chance of Clinton winning, 43% chance of Trump winning 9 electoral votes. If that flipped the other way, Trump wins. So it really, as of Monday's race, it really comes down to who wins Colorado, assuming all this other stuff holds true. Again, how to look at this? This is just a benchmark, a baseline for where we think we are in the race right now. You may have a very different view from this, and then and we've still got 5 more weeks, and this can change quite dramatically. And again, it says, if the election was held today, that's where we would have been as of Monday, right before the race. Going to the next slide, what is their forecast for the election on election day? They have a different model, which they call their Polls Plus model. It's almost identical. 56-44, very close tightening of the race, 277 electoral votes to 261. And on the next slide, that shows the same thing. It all comes down to Colorado. So what I wanted to leave you with is this idea. This race is about as close, at least as of September 30th, as we have seen in at least a generation. Now, a lot can happen between now and November 8th. A lot cannot happen between now and November 8th that can swing this either way. So I think we have to start from the baseline that this race is somewhat of a photo finish. If I go to the next slide, this is the betting markets. There are active betting markets on the election. There have been active betting markets on the election since the Civil War. And actually, we do have that data going back to the Civil War. And I hear some of the chuckles. I'll point out that before the invention of the Securities and Exchange Commission, between 1860 and 1930, they used to list the candidates on the New York Stock Exchange, and usually in September and October of an election year, between 1860 and 1920. That was 40% of the volume of the New York Stock Exchange during those periods. It was the biggest thing that everybody bet on. And interestingly, the election betting in the 19th century had as equal, if not a better track record than the scientific polling that we do in the 21st century. So the bettors tend to have a pretty good handle on what's going to go on with the markets. Now, they're not perfect, and if you want a great example of that, a couple of months ago, if I was here, I would have showed you a similar chart with Brexit, and it would have showed you something similar. This chart shows you Hillary at 69%, Trump at 33%. All throughout the spring and early summer, the bettors were 70% chance that Brexit would fail. It will fail. It will fail. It passed. So they can get it wrong at times, but most of the time they don't. And right now, they're giving you about a 30% chance of a Clinton victory. The next slide shows you what I wanted to highlight about the importance of the debate. These are the volumes that trade on the exchange right now. And you can see Monday's debate was the second highest volume day we saw. The only other day that was higher was the Indiana primary back in May when Trump clinched the Republican nomination and Clinton surprisingly lost to Sanders. That set up California as being significant. So if you just go from a volume perspective, the market is telling you that whatever happened on Monday was an important event. So to tie it up, Monday was an important event, and going into it was very close. If I go to the next slide, what does it mean for the markets? And this is where I think it gets interesting from an election standpoint. The red line on this chart is the S&P 500. It's the stock market. The green line on this chart is Hillary Clinton's betting, the daily betting on Hillary Clinton. It's 89% correlated. It's almost moves in lockstep with the stock market. Now, if we go to the next slide, Trump is the blue line, the red line is the stock market. It's 18% correlated, almost a random movement. The interpretation of this right now is that Hillary, being the establishment candidate, is the more known and understood candidate. She moves up and down with the fortunes of the stock market. That part we get. Trump is an unknown. And because he's an unknown, he's not negative, he's not positive, he's an unknown. He's a random event. We don't know if he's good or bad or in between or where he fits into this equation because we've never seen something like that before. A fun stat that I recently heard about Trump, he's the first candidate in American history to have won a major party's nomination without previously being a politician. He had never won office before or being a general. Everybody else who's ever won in American history has either won an office before or has been a general, and usually a general that won a war like Eisenhower. Trump is neither one of those. So he stands unique in what we've seen before, and I think that that's what the market is trying to tell us. We don't know what to make of him. Not going to conclude he's bad, not going to conclude he's good. It's just kind of a throw your hands up in the air. Final thing on the election is the next slide. I wanted to just make a quick word about the Senate. The House, according to the betting markets and the models and everything else, 90% chance it's going to stay with the Republicans. We could argue about how many seats. But the Senate is what's up for grabs. Right now, the betting markets have a 42% chance that the Senate is going to be in Republican hands, 58% chance it's going to switch to the Democrats. If I go to the next slide, this is the 538 poll, and I want to point out one nuance about this. They've got it 56-44, very close to the betting markets. The betting markets are saying 42% chance Republican. His model's saying 44. But if you look at that part in the middle right here, this gray area, and what this says here is it's all going to come down to that the bettors think that the Senate's going to be 50-50, and the tie is going to be broken by who wins the election. That it's that close as far as the Senate goes. It might actually come down to that we have a 50-50 Senate, and then whoever is the new vice president is going to turn this down. So it is a photo finish election. No one's seen anything like this. At least it is as of now. We will find out as early as today. This afternoon, we're going to start getting the first real post-debate polls and into early next week. Did it matter, the outcome of the debate? The perception is that Hillary won, Trump lost. Okay, does that matter? We'll find that out with some of the polls. Is it sustainable? And can it be reversed in the second or third debate? Usually those answers are a lot clearer in a normal election, but this is not a normal election. So that's what's made this one a little bit more difficult. So if I turn now to slide 15, I want to pivot a little bit, and I want to talk a little bit more about a more investment theme, and that is what's happening with interest rates. This shows two-year yields around the world. The US is in black, and you can see all the other ones. And notice the line is zero. Most of these interest rates are at negative. Leading the negative parade is Switzerland at almost -1 basis point, -94 basis points as well, too. And every country listed here has a negative two-year note except the United States, which is at positive 75 basis points as of 2 days ago when I last drew this chart. The next slide shows a book that was written originally by Sidney Homer in the 1950s called A History of Interest Rates and was updated by Richard Sala in 2005. That's the 2005 version. Sidney Homer, by the way, was the guy that started the first bond research department at Goldman Sachs in the early 1950s. And as the next slide shows on 17, he actually did trace interest rates back to Mesopotamia, 5,000 years of interest rates. And this chart starts at 3000 BC and it goes to 2005. And what you don't see on that chart is negative rates. That book has 710 pages. It was written in 2005. There is not one reference to negative rates in that chart, in that book anywhere. So as we go to slide 18, currently in the world, as of September 27th, there was $13.4 trillion worth of bonds that were trading at a negative interest rate. That is the green pie slice on it. There is 40% of the market is 0 to 1, 1 to 2, and only 6% of the market is yielding more than 2%. And most of that red slice is long-term U.S. Treasuries. The 30-year Treasury is yielding above 2%. So this is new. And if we were to go to slide 19, it's new and it's something that we haven't seen before. Where are those negative interest rates? The green slice on this pie, 55% or 7.3 trillion of that is in Japan. And that only started in January. As of December 31st, Japan had no negative interest rates. Now they are the bulk of the world's negative interest rates. All those different colored blue slices are the different Euro countries. At the top, Germany, France, Italy, Spain, Netherlands, Belgium, they all use the euro as their currency. And then there's a small slice of gray at the top. That would be Switzerland and a couple of the other countries as well that have negative interest rates. So what I wanted to try and point out from you is this is wholly unique in America, and not only American experience, human experience, this idea of negative interest rates. It is an alien concept to even people that have been in the bond market for almost 30 years like me, that you got to turn everything upside down. So I borrow money from the bank, and the bank pays me. And I'm still trying to, I have to keep reminding myself of that over and over again because it's just not how the world is supposed to work. So slide 20 asks the question, how did this happen? So let me start with talking about the role of central banks, because I think that central banks are the primary driver of this. Here are the 4 largest central banks outside of China. China's a different and a special circumstance, so I'm excluding it from this conversation. The purple line is the size of the Federal Reserve's balance sheet. The Federal Reserve, all central banks are still a bank. It currently has $4.2 trillion on its balance sheet, and it's been fairly stable And I'll talk about that fairly stable here in a few minutes. The green line is the Bank of Japan's balance sheet, which in the last couple of weeks has just surpassed the Federal Reserve's balance sheet as being the largest central bank in the world by assets. The gold line there is the ECB, the European Central Bank, and the blue line is the Bank of England. Now, you'll notice that with the BOJ, and you'll notice with the ECB that their assets have been going up. That is because they are actively buying bonds in the marketplace. And I'll talk about that in a second, but let me go to slide 21 to give you a better perspective on what this looks like. Each one of those colors adds up on the right scale to the size of those central bank balance sheets. And when you get to the top, and I'll show you this in the next slide in a second, it's 13.3 trillion. And the red line shows you the size as measured by GDP of the countries. It's about 1/3 the size of the country. So the four central banks of Japan, the United States, the European Central Bank, and the Bank of England, their balance sheets have ballooned now to about 1/3 the size of their economies from less than 10% before the crisis in 2008. Now, if we go to slide 22, here they are again added together at 13.33 trillion. Let me make sure we're all on the same page here, what's going on. This is Central Banking 101. Each central bank is a regulator for the banks in that country. Every bank has an account with the central bank that they have to keep their reserve requirements in. And the central bank sets rules on how much reserves you have to keep. And to give you an example, if I was $1 billion bank, in my reserve account, I would have, if this is the Fed, roughly speaking, about $110 million. Roughly 11% of my assets have to be in my reserve account at the bank. Now, that varies from bank to bank and varies from asset to asset, but we'll just go with 11% for right now. When the central bank wants to stimulate the economy, it will add reserves to the central bank, to my reserve account. What does that mean? That literally means they will say, my 110 million, okay, we'll erase that number and we'll make it 120. Now, if you did that in the private sector, everybody goes to jail because that's fraud and that's cheating. But that's what we call sophisticated monetary policy. And if they wanted to, and the reason that they would add money to my account, all right, now my 110 million is now 120. I can expand my bank. I can hand out more loans. I can buy more securities. If the economy is growing too fast and they want to slow it down, they would say, my 110, we'll erase that, we'll make it 100. Now I have to sell off some assets. I cannot expand my loan portfolio as fast as I want to. That's traditionally the way it works. So what they've been doing lately is they've been buying bonds. And they've been going out to the banks and saying, we would like to buy bonds from you. And so the bank would say, okay, here's $50 billion worth of a bond you want to buy. Fine, we agree on the price. We'll go into your reserve account. We'll just change that number, add $50 million to it. That's how they've been paying for it. The vernacular we like to use with that is printed money. It's money that doesn't exist. They just created it out of thin air to purchase those bonds. Here in town, the former chief economist of the Northern Trust, who's a friend of mine, Paul Casriel, used to call the central banks legal counterfeiters. And that's a way that you could kind of think about the way that they work. So they have been buying bonds and they have been expanding their balance sheets that from 2009, it was $4 trillion, and it's currently $13.33 trillion as of last week. The bars on the bottom chart show you the change in their balance sheets. It is over a year-over-year basis. It has increased by over $2 trillion in just the last year. Now, if I go to slide 23, this shows interest rates. This is the yield of that pie chart I showed you a minute ago. It's currently the worldwide average yield of government bonds is 1.1%. It has come down from over 4% in 2009. And the blue line bars on the bottom are the year-over-year change in yields. So this gets me to this next slide, slide 24. What slide 24 does is I combine the two previous bottom panels together. So the blue bars on this show the year-over-year change in balance sheets of the major central banks. And then I inverted and put it in red interest rates. So when interest rates fall, that's an inverted scale. It gets more negative. The line goes up. And when interest rates stop falling, the line goes down. And what I want to show is that the central bank activity leads. So when the central banks start aggressively buying bonds and accumulating bonds, interest rates fall. When they stop, they rise. when they start accumulating assets or buying bonds, interest rates start to fall again. The biggest driver of interest rates right now is central bank activity. This is my printing press. They're just cranking away at the printing press, buying bonds. They're driving rates down so low that they have now driven them in Japan and in Europe to negative rates. That is what has been the principal driver behind this. Now, why is it that they're doing this? They're doing this, in essence, because they're trying to stimulate slow economies. They're trying to stimulate the markets as well, too. Let me use the Federal Reserve as an example. This is a 50-plus year chart, actually almost 60-year chart of 10-year yields. So here's where they were in the early 1960s, late 1950s. They peaked at around 16% in 1981, and we're down at 1.5% right now in the U.S. Within interest rates, if you were to look at a 10-year yield, is made up of a 1-year bond and a 2-year bond and a 3-year bond and a 4-year bond, and you stripped out all of that reinvestment from a 1-year bond to a 2-year bond, you get what's called the term premium. The amount of riskiness that the market is assigning to bonds to own them. If they perceive that the world is risky, they demand a big risk premium. If they perceive the world as less risky, they present a lower risk premium. The risk premium is the lowest ever. And that is really scratching everybody's head. This is not the safest, most understood environment. Why is the risk premium is so low? And the slide on 26 answers that. This is Janet Yellen, Federal Reserve Chairman, speaking in her June 15th press conference. I want to read the red part. This is from her transcript. Now, when we engage in long-term asset purchases, that bond buying with that printed money, our very purpose in doing that was to drive down long-term yields by making these assets scarcer, and then hence more value to the public that wants to invest in long-term securities, and we were consciously attempting to drive down that term premium. So that red line, they were trying to drive that red line down. They did it. What is happening here? When a central bank buys a bond, and this is the theory that's been kicked around in the market for the last couple of years. When a central bank buys a bond, that bond is off the market. It's never coming back. To give you an example with the Federal Reserve, the U.S. Treasury has issued $20 trillion of debt. Watch the debates. You'll hear that word come up, that 20 trillion number come up over and over again. 3.6 of it is held by the Federal Reserve. The market believes that that 3.6 trillion is effectively canceled. It will never see the light of day. A private institution, Marquette Associates or any major bank, will never have to own it. As a matter of fact, to go one step further, what the Federal Reserve and all the other central banks do is in January of every year, the coupons that they collect on that $3.6 trillion portfolio is given back to the Treasury. In January, they wrote a check for $98 billion back to the Treasury for that coupon. Whenever one of those bonds matures, it's rolled over. So effectively, that $3.6 trillion has become one single security with no maturity and no interest rate. If you have a security with no maturity, no interest rate, its value is zero, is essentially what has happened. So the market has decided that whenever a central bank buys a bond, it's gone. It's never going to be seen by the marketplace again. It collapses the available supply of bonds. The demand doesn't change. The price goes up. Yields fall until they go negative. The concern in the marketplace right now, and this gets me to the slide on 27, the concern in the marketplace is what happens when they want to sell those securities back into the market. Well, right now the market doesn't believe that that's ever going to happen. And you could see that even in the way that the Federal Reserve is operated. If this was 4 years ago, I would have said that the Federal Reserve had a certain sequence to normalizing interest rates. They would stop buying bonds. They would stop reinvesting. Remember the purple line being flat. That's that every time a bond matures, if $1 billion of bonds mature, they buy another $1 billion. They keep reinvesting all the matured bonds. They'd stop the reinvestment. They'd let their portfolio, their assets, their balance sheet fall, and then they'd raise rates. That was 4 years ago. Today it was they stop buying bonds and then they start raising rates. Why did rates go from the last sequence to the second? Because the Federal Reserve knows that the minute that they or any other central bank suggests that QE is going to end or that they might sell down their portfolio, the marketplace gets all bothered by it. September 9th, Mario Draghi, the head of the ECB, the European Central Bank, had their meeting, held a press conference. There was a concern there. The ECB is buying bonds. They have a limit that any bond, this is like Twilight Zone stuff. They cannot buy bonds at minus 40 basis points. A couple of years ago, I would have thought I'd never say that. You can't buy bonds at minus 40 basis points or lower in yield. That's 2/3 of the German bond market right now, 40, minus 40 or lower. So the marketplace said, well, hopefully the ECB will address that issue. You're running out of bonds to buy because of that minus 40 floor that you've self-imposed. When Draghi was asked about that question, his answer was, it didn't come up in the meeting. How could it not come up? It's the most important issue right now. The next day, the Dow Jones Industrial Average fell 400 points. And the reason it fell, that was September 10th. The reason it fell 400 points is a concern. If it didn't come up and they don't have an answer, maybe we're seeing the end of QE. And if we're seeing the end of QE, we don't like it. The way QE is supposed to work, quantitative easing or bond buying, I use those phrases interchangeably. Federal Reserve and the ECB, Bank of Japan, Bank of England buy bonds, drive rates down. They force people to move out the risk curve. I'm not going to own negative yielding bonds. I'm not going to own 1% yielding corporates. I'll buy something riskier that gives me more of a return, hopefully towards equities. Risk assets go up. That's a fancy way of saying the stock market goes up. So they drive interest rates down, push everybody out to buy riskier stuff, risk assets go up. That's happened so far. What's supposed to happen after that, which Ben Bernanke used to talk about between 2010 and 2013, is that higher asset price is supposed to create a wealth effect. Businesses see that their value has gone up, they expand. People see that they're worth more because their portfolios went up, they spend that money. That has not happened. The reason we've argued that it has not happened is because the perception is this is all artificial. I'm not unhappy my portfolio went up. I'm not unhappy that my business is worth more. But it's happened because of this artificial suppression of interest rates, and when that stops, it's going to go back down. So I'm happy that it went back up. I'm not about to spend that extra profit that I see because I'm afraid it might go away. And I've also seen it go away twice in 2000 and 2008 as well, too. That's why we're not getting the wealth effect. And I might interject that the Wall Street Journal had an interesting piece by their Fed watcher a couple of weeks ago. His name is John Hilsenrath, and he's very connected to the Fed. And the piece was talking to some Federal Reserve officials that they've admitted that this hasn't worked. And if anything, it's created exacerbated wealth inequality. We drive the assets up in the upper half of the income scale, and rich people own assets, and they see their net worths go up. The bottom half is not benefiting from this, and that's why we've got these populist movements, not only in the United States with Trump, and don't forget Sanders, but also across Europe as well, too, that this is exacerbating this issue. So what is it that the Fed is going to do now about this? Let me start with this chart here. There is a futures contract that you can trade on with the federal funds rate that is, in essence, a bet on whether or not the Fed is going to raise rates. And this contract's been around for almost 30 years right now. And I look back in the post-Greenspan era, so since 2006, whatever that contract expected from 35 days before the Fed meeting to 1 day before the Fed meeting, 35 days before the Fed meeting, whatever priced in was 88% right. 10 days on in before the Fed meeting, it was 100% right. Whatever that contract prices in happens 100% of the time in the 2 weeks leading up to the Fed. This blue line is going into the September 21st meeting. It never went above 50% once. The Fed did not raise rates. The marketplace has got the Fed wired. It knows exactly what it's going to do weeks before it does it every single time. Now, most Federal Reserve officials would say, yeah, this is because we have a thing called forward guidance. We tell you what we're going to do, and you price it in, and it happens. But I think that something different has been going on in the marketplace over the last year or so. The market has also figured out that the Federal Reserve will not defy us. It will, if we don't price it in, they won't do it. And so, therefore, we don't price it in, and then they cave time and again. And that's why you hear people talking about the Federal Reserve's credibility. They keep talking about, we're going to raise rates, we're going to raise rates, and then the meeting comes, and then they don't do it. Why didn't they do it? And then they give you these obtuse arguments about data dependency and everything else, and no one understands what they mean. But at the last meeting, they said, aha, if we go to the next slide, 28, at the last meeting they said, okay, now we're really going to do it. I swear to God, we're really going to do it at the December meeting. And that's even fostered the argument now that they're political. You wait until after the election to do it because you've got an inherent bias within there. I don't personally believe that to be the case. But boy, oh boy, they make it hard to defend them when they sure act like that they're being political as well, too. What this chart shows is the green line on the top chart here is the Fed funds rate. And this is when they raised rates last year. The blue line on this chart is where the Fed, where the contract that expires in January, that discounts where the funds rate's going to be after the December meeting. So the bottom chart in red shows you how much of the December meeting is priced in, 15.5%. If you look at the CME's website, if you go to the Chicago Mercantile Exchange's website, they actually have on their website a page where they update the probabilities the Fed's going to raise rates at all their meetings every 10 minutes. It's 57% is what the chances are that the Fed's going to raise rates in December. Now, a lot of people say, well, it's above 50. That everybody's figured this out. It's above 50, so therefore it's game on. Well, wait a minute. We've seen above 50 quite a bit in the last year and a half, and it hasn't come. It happened once when it went to nearly 100, but it didn't happen in May and June. It didn't happen in August. It didn't happen last year in September. So it's kind of in a no man's land as well, too. And then there's the bias in the market. If I go to slide 29, what does the market think about interest rates? What does it always think? So here's the black line is the funds rate, right? It was stuck at 25 basis points till they raised it last year. These are all the forward curves of what the market thinks the funds rate's going to do over the next 2 years. It always thinks it's going to go up. And eventually the stop clock is going to be right at some point across the line. So let me skip ahead now to slide 31. And this is what the Fed's worried about right now, is that the reason that the Fed has the marketplace, or the marketplace is running the Fed, is what we saw on September 9th when Draghi did not address the German bond issue at minus 40, down 400 basis points. This is what the Fed this is the monster that the Fed has created. The market is addicted to easy money. The market wants more and more easy money. The minute that the Fed threatens to take it away when the market doesn't want it, it throws a fit. And then the Fed caves and says, okay, we won't do it. And this is what they have to overcome. Now, maybe the market gives them a pass in December and prices it in like it did a year ago, and it lets them raise rates. But if it doesn't, the Fed's got a choice to make. Do they raise rates, even though the market doesn't expect it? And do they risk, as I like to say, the first question at the press conference being, Chair Yellen, you raised rates a half an hour ago, and the Dow Jones Industrial Average fell 1,000 points because it wasn't expecting it. It's all your fault. Everything's your fault. Whatever happens from here is your fault. They don't want that question. They never want that question. That's why they cave time and again. Why is it that they want to raise rates? I think that the Fed has concluded that QE doesn't work. Let me define doesn't work. Yeah, it pushes interest rates down. It pushes people out the risk curve. It pushes up the stock market. But it doesn't create jobs and it doesn't create GDP. And it might foster inequality and a populist movement. And they want to stop. They can't say that. That would be quite the story if they said that. So they want to raise rates and they want to get back to normal. But they don't want to blow up the market at the same time. So they want the market to kind of agree with them and let them do it. And the market is not. It's pushing back on them. And they keep caving time and again on this. And that's the dilemma that they're caught in. I don't think they're going to do it in December unless the market prices it in. And that's you could go to the CME's website. You can look. There's various places you can see where the probabilities are. If it's priced in, it happens. If it's not, they won't. And it's just that simple. It's out of their hands. It's in the market's hands, and I don't think they're ready to do it. Let me go to slide 33 and conclude with this newfound investment period. A story from the Financial Times a couple of weeks ago. Active managers' exposure, most U.S. equity funds lag behind. The story says that in the year ending June 30th, 2016, 90% of all actively managed funds underperformed the S&P. And if you go to slide 34, there's the chart of it. only 10% outperforming. The last time we saw it this bad was 1998 and 1999. Big difference. In 1998 and 1999, the stock market was up 40%. The NASDAQ in 1999 was up 85%. When the market roars ahead with a huge year like that, managers tend to underperform. It's impossible to keep up with a market like that. Customers are not that unhappy because, okay, the market was up 40, I'm up 32, we lagged, but I'm up 32. In the last year, the market was up 5%, and 90% of managers underperformed, only 10% outperformed. And this has been a trend in the post-crisis era since 2010, where more and more managers have been underperforming in the marketplace. Richard Perry of Perry Capital called it quits this week. He's been running a hedge fund for 30 years. He wrote a letter to his investors to say that his style is no longer working, and although I continue to believe very strongly in our investments, process, and team, the industry and market headwinds have been against us, have been strong, and the timing of our success has been too unpredictable. The blue line here is the S&P's 500's return over the last 5 years. It's up 63%. All these different colored lines are various returns for groups of hedge fund managers. Equity hedge, long short, global, macro, equity neutral. They've lost money in the last 5 years when the market's up 63%. There is an existential crisis going on in the hedge fund community right now. Why do they exist? What is their purpose? They cannot outperform to save their life as a group. And you're also seeing this, if we go to slide 37, Ken Fisher. Ken Fisher, the Forbes columnist, runs Fisher Investments out in Oregon and in California. One of the great investors of our lifetime. He really is one of the great investors of our lifetime. Fisher wrote in the Financial Times on September 7th, something he's been writing about for many years. It doesn't matter. Money is simply a measuring stick. It doesn't manipulate despite what people believe. Just as the once world believed the world was flat, it does not matter if banks tend to lend to appropriate borrowers. That's what it's all about. You want to be steady, not gyrating wildly because central bankers took themselves too seriously. If I go to slide 38, I love Ken. He really is one of my heroes, but since 2011, his performance has been awful. And it's been awful, and I'm picking on him, and I could put Bill Miller, I could put Ron Barron, I could put Warren Buffett, I could put a lot of people in this post-crisis period. What's happened in the crisis period is summed up by a successful manager named David Tepper, who runs Appaloosa. David Tepper said in 2010, in the post-crisis world, it's either the economy gets better, earnings get better, and the stock market goes up, or it doesn't, and central banks print money, and everything goes up. And what a lot of these guys that have great track records prior to 2008 have been fighting is, it's about the fundamentals. It's about kicking the tires of the companies. It's about understanding the product, the position, the financial strength of the company, and you invest in it for the long term. Now, that has been a tried and true way of investing. The problem is in this environment of extreme central bank policy, buying bonds, driving rates to zero, and all this stuff, it has changed the environment that a lot of these guys that keep fighting this, no, it's wrong, that's not the way the world works. Peter Lynch, the great Fidelity Magellan manager of the 1980s and 1990s, once quipped in 1990, as a matter of fact, if you spend 13 minutes a year thinking about Fed policy or macro considerations, you've wasted 10. It's now the opposite. If you've spent 13 minutes a year thinking about individual fundamentals, you've wasted 10. And I don't mean that directly, I mean that because that's what seems to be driving the market, and that's what everybody's struggling with. All this stuff about Fed policy and everything, and negative interest rates, it doesn't matter is what they keep saying, and that turns out to be their performance. And I'm not picking on Fisher because it's a lot of people, 90% underperforming. And that is what the real struggle is. The thing I would leave you with is that it's all cyclical in this business. It's not secular. I don't think this central bank driving of interest rates to negative and dominating the investment landscape is a good thing. It is not a good thing, but it's the world we have right now. And that's what we have to adapt and move with, that world. It will not be that world forever, but it is that world now. And those that are slow to recognize it and still want to, pull out their 1996 playbook and say, this is how the world works. They're struggling as much as the political consultants that pull out their 1996 playbook and say, this is how you run an election, and then you wind up with what you've seen with Trump and what you've seen in Europe, and even Bernie Sanders. As I like to say, Trump got 58% of the vote, and he became the nominee. Bernie Sanders got 45, and he came up just a little bit short. So, there wasn't much, and the commonality between them is the anti-establishment populist outsider, although from different ends of the political spectrum. But that is what seems to be the case in the marketplace right now. Let me stop there. Let me thank you. Let me open it up for any questions that anybody might have. Yes.
Those negative interest rates are approximately what it costs in terms of transactions to go through the know your customer route canal, to open up new banking relationships, to worry about FDIC coverage. Is it possible that these negative interest rates are really real zero interest rates from the perspective of the treasurer, but that the floor for interest rates that we've been talking about academically for 100 years is really something closer to 50 basis points, and we're kind of getting into this, hey, we've got negative interest rates, the world's still here, but it turns out the landmine is actually buried just a little bit deeper?
Yeah, let's first of all remember that negative interest rates are not in the United States. We still have positive interest rates. Negative interest rates are still an artifact largely in Europe and most recently in Japan, and in Japan for less than a year. And let's look at what's been happening in Europe. Negative interest rates has been a big issue for the banking community. At first, you like to say that European bankers, when they first saw negative interest rates, that we've used the metaphor of if you've ever stood on the corner and you knew that there was going to be a car accident that was going to happen right in front of you, you didn't say anything, you didn't yell, watch out, because you were processing this. Am I really seeing what's going to happen? Is this really going to happen? You weren't quite sure you were seeing what you were going to see. And that's what European bankers were like the last 2 years. Negative interest rates. Is this really happening? Is this going to last? What does it mean? I'm not sure that I'm seeing what I'm seeing. And they stalled. And because they stalled, what we're finding is that their banking community in a negative rate environment is really suffering badly. Look at no less than the Wall Street Journal today or the FT today about the stories about what's happening with Deutsche Bank, with Commerce Bank, with Monte dei Paschi, the largest bank in Italy. They're really being squeezed quite hard. And one of the reasons they're being squeezed from your treasurer standpoint is negative interest rates are at the banking level in Europe. At the retail level, there is no negative deposit rates. If you open up a bank account right now in Europe and put your money in Europe, you're getting zero as your interest rate. So they're not taking money out of your account is what they're doing. That would be negative rates. They would charge you every month as an interest rate charge, not just a maintenance fee charge, you every month to have your money in the account. They're not doing that. So at one level, a lot of the businesses in Europe are not experiencing negative interest rates. The banks are, and that's why they're being squeezed. They're being squeezed so hard right now. So it is hurting them. And as far as your argument about fees and everything else, Chairman Bernanke noted this in his blog post. He's at Brookings Institute right now, and he blogs about monetary policy matters in baseball all the time. He's a big baseball fan, too. Bernanke said that in 2010, the Fed considered the idea of going to negative interest rates. And they actually did this study. They looked at the vault space of every bank in the United States, the volume of vault space. And then they said, what if you were to just wheel in pallets of $100 bills in all those vaults as your reserves? Your reserves can be cash. So instead of having a negative interest rate reserve, just get the forklift trucks and just stack $100 bills in your vaults. What's the break-even interest rate that you would see before people would start wheeling in those pallets of currency? And he said it was minus 37 basis points. Europe, he went on to say, has a 500 euro note. We have a $100 bill, and the 500 euro note has 6 times the value in the same space of one piece of currency. Their break-even's closer to zero, so it's higher than minus 37 basis points, yet their rates are way lower than 37 basis points in Europe, and it's irrational what's been happening, because I think it's that metaphor of that car accident. A lot of bankers just, I can't believe what I'm looking at. I don't understand it. And the joke was, one German banker once told me, yeah, and he goes, there's a story going around that, some senior German banker, some young assistant vice president, when an iPad ran up to him and said, here, look, if we if we get rid of all these borrowed reserves at negative rates and we wheel in pallets of 500-euro notes in the bank's vault, we save all this money. And the senior German banker said, son, that's not the way we do banking. Well, it is in 2016. It is in a negative rate environment. And you might be like Ken Fisher and the rest of them, slow to adapt to the new environment because it's really an anathema to what you've been taught for the first 35 years of your career. But this is the way we work. So it isn't hurting at that level. It isn't hurting on the treasurer level. It isn't hurting at the retail level because they're not seeing those negative rates. But it is squeezing very hard at the financial level. And that might be one of the reasons why we have the stories about Deutsche Bank today in today's paper. And Mario Draghi had to come out 2 days ago and said that what's happening at Deutsche Bank has nothing to do with negative interest rates. Well, of course, you're supposed to say that. You can't say that our policies made it worse. You never admit that. But that's the perception that everybody has right now. And remember, we don't have those here in the U.S.